Do you want to know what stocks I'm actually investing in? Let's take a look.
Wait!
What now, magical floating logo?
Don't forget to tell them that this is not financial advice. I don't want us getting sued.
I don't actually think it's possible to sue an imaginary character.
What did you just call me?
So when investing in stocks, they are typically grouped into one of three categories: value, growth, or blend. Value stocks display characteristics such as a focus on profits. They might have some slow and steady growth. They might pay a dividend. They might buy back their shares. And they typically have a pretty low valuation on most general valuation metrics. Growth stocks are the opposite. They're going to have high growth at the expense of lower profits. They're focused on capturing market share and growing their revenues so that they can make profits in the future. These tend to come with higher valuations because the market prices in a lot of that future growth. Then there's blend or core stocks, which is my personal favorite. And these are stocks that display a little bit of both. Maybe they're growing at a decent clip, and maybe they're showing some pretty decent profitability today, while still having some prospects of profitability in the future. They might pay a growing dividend, but they might also have sometimes double-digit revenue growth. Those are the types of stocks that I like to invest in. So let's talk about my portfolio. I'll show you guys the 20 stocks that comprise my core portfolio. Let's start at the top. Thermo Fisher, ticker TMO, makes up 10% of my portfolio, and it is my largest position. Thermo Fisher describes themselves as a world leader serving science. This is essentially my picks and shovels play for the biotech pharmaceutical industry. Thermo Fisher is a massive company, over $200 billion in market cap. And if we look over the past 6 months, Thermo Fisher Scientific is actually down while the market is hitting new highs. And if you know me, you know I love to buy a quality company at a good price. They are sort of a healthcare conglomerate. They sell diagnostic equipment, they sell laboratory equipment, they sell chemicals, they sell devices, machines, consumables, pretty much anything that the pharmaceutical and healthcare industry would need. Thermo Fisher is going to be able to supply that to them. So when there's weakness in one branch of their business, another branch should be able to pick up the slack. As far as the weakness in the stock price, I believe that that's mostly attributed to macroeconomic conditions and geopolitical conditions. It's a really tough time to be a biotech company right now while interest rates are still very high, and a lot of their pharmaceutical customers are cutting their budgets. Additionally, with the new administration, there's a lot of uncertainty around what changes might happen. In the US, if you're unaware, we just got a new chairman of the Department of Health and Human Services, so a lot of people are speculating that that's not going to be good for the pharmaceutical industry. However, I invest for the very, very long term, so a change in administration doesn't really matter too much to me, and I'm very happy to hold Thermo Fisher as my top position during this weakness. Let's move on to the next stock in my portfolio, which is ASML, and this makes up about 9% of my portfolio as of today. For those unaware, ASML is a semiconductor company, but they don't actually make semiconductors. They make semiconductor manufacturing equipment, which they sell to what's known as fabs or fabrication plants for semiconductors. So think things like Intel has their own fab, TSMC is the world's largest fab, and Samsung is also a very large customer. What they manufacture is known as extreme ultraviolet or EUV lithography machines. Now, these are machines that are crucial to the semiconductor manufacturing process, and nobody else in the market essentially is competing with ASML. They hold over 80% market share in EUV lithography. Now, this is an extremely cyclical business because the devices that they sell cost millions and millions of dollars, and so each year they might only sell a handful of machines, but they also make revenue from servicing these machines, which gives them a bit of a recurring aspect. However, what we're seeing right now is a lot of cyclicality and some uncertainty with ASML's customers. As we can see, the stock hit a peak of around almost $1,100 back in July and is now down around $700, about 36% off of its peak. So what's going on is that their revenue guidance for the midterm is a little bit weaker than analysts had expected. And for me, I'm okay with that. They're still expecting anywhere from 7 to 25% revenue growth in 2025. So I think anything can happen. And while there's also a lot of uncertainty around trade restrictions and China tariffs, I think a lot of that is baked into the price for ASML. I think that this is a monopoly, and even though they're cyclical, they have that staying power because their equipment is vital to the most advanced semiconductor chips on the market right now. And that's why I'm happy to hold ASML today. Next up, along that same line, is Applied Materials, ticker AMAT, and they also provide semiconductor manufacturing equipment. I like to think of it this way. ASML is the specialist. They are specialized on EUV or extreme ultraviolet lithography, whereas Applied Materials is the generalist. They sell a broad range of equipment to semiconductor manufacturing companies, again, like TSMC, like Intel. This is a massive market because it doesn't matter what kind of semiconductor it is, it needs to somehow be manufactured, and there needs to be advanced equipment to manufacture these semiconductors. So Applied Materials equipment is used to make AI chips, electric vehicle chips, robotics chips, you name it. While ASML experiences a lot of cyclicality, Applied Materials cyclicality is a lot less because they are so broad and so diversified. This is a massive $150 billion company, and they're actually the largest semiconductor manufacturing equipment company by revenue. As you can see, their stock price has also been beaten down a little bit. It's down about 15% in the past 6 months, despite some really strong revenue growth due to some tailwinds in AI. So that's why I've been adding to Applied Materials lately, and it is currently my third position at 8% of my portfolio. I love these semiconductor picks and shovels plays because they really stand to benefit no matter which semiconductor chips are experiencing a bull cycle at that particular moment. Next up, it's Intuitive Surgical, ticker ISRG. I have referred to this stock as a money tree in my previous video, and I stand by that statement. This is certainly not a cheap stock. It's actually up 70% in the past year, and it's up 174% in the past 5 years. This stock just keeps on going and going and going, and I've actually been averaging up because I just believe this is such a wonderful company. Intuitive Surgical makes these robot-assisted surgery devices. It's called the Da Vinci system. It's a big robot with a bunch of arms that's controlled by a surgeon, and they perform what's known as laparoscopic surgeries. So these are minimally invasive surgeries, usually through the abdomen, and they've been shown to have a lot more success and to be much safer than traditional non-robotic assisted surgeries. The reason I call them a money tree is that hospitals will spend a good chunk of money to implement the Da Vinci system, and then every time a surgery is performed, they need to buy new consumables such as these little blades at the end of the robotic arms because they're only single use. So anytime Intuitive Surgical makes a sale of a device, they're also getting downstream revenues in the future from these consumables that hospitals are going to have to keep on purchasing. So this is a company that is making surgery safer, sometimes cheaper, and increasingly patients are growing to trust robotic-assisted surgery. This is a massive market, and Intuitive Surgical dominates it with a 70% market share. They have amazing margins, amazing revenue growth, amazing profits, and their balance sheet is incredible. They're sitting on $4 billion in cash right now with no plans to use it. I'm very bullish on the future of robotics, and I think healthcare as a sector is a very safe sector to be in, so I'm really happy to hold Intuitive Surgical at 7% of my portfolio. Next up is Tesla. Now, Tesla is a very controversial stock, and I'm sure everybody is at least a little bit familiar with Tesla if you're watching this video, but Tesla is my 5th largest position at 6% of my portfolio. This is a company that I believe is extremely innovative. They have the #1 market share in electric vehicles, and they have a lot of future growth prospects in areas like solar and humanoid robots and self-driving cars. I think if even one of these theses plays out, you could see continued growth for Tesla for years and years to come. I don't think there's much more that needs to be said about Tesla. They have this great combination of growth and value, and I'm very excited to see what the future brings for this stock. Next up is Alphabet, or more commonly known as Google. I initially invested in this company because it was lagging the broader market, and I believe that this is a quality company that likely should be outperforming the market. There's a lot going on right now with this company as they're facing some legal battles. The DOJ, or the Department of Justice, has recently declared Google or Alphabet an illegal monopoly. So what that means is a bit unclear, but it's possible that Google may be broken up into smaller businesses, or they may have to sell parts of their businesses. For example, the DOJ has suggested that Google sell their Chrome browser as one idea of a remedy for this situation. Regardless of what happens with the DOJ investigation, I think Google is a wonderful stock to own right now. They are one of the 3 hyperscalers in the cloud computing space, which is what most excites me about Google. Now, these are Amazon Web Services, Microsoft Azure, and Google Cloud. Essentially, these 3 companies have built out a massive infrastructure for cloud computing, and other businesses can use their services to run cloud-based applications on their infrastructure. It's a very lucrative business. It comes with high margins and strong growth. Additionally, this is the leader in digital advertising by far. That's how they make most of their money, and I don't see this going away anytime soon. So for me, Alphabet is a pretty solid bet for my portfolio and makes up about 5% of it today. Next up is Palo Alto Networks. This is a cybersecurity company, and it's actually the largest cybersecurity company by market cap. Palo Alto Networks is a broadly diversified cybersecurity company. They started out offering firewalls, but they've expanded expanded and now have lots of cloud security offerings, as well as network security and even data security. I think that Palo Alto Networks is the best way to play cybersecurity, and if I could only pick one cybersecurity stock to invest in, it would be Palo Alto Networks. This company currently makes up 5% of my portfolio, and I'm happy to continue holding the stock. Next up is NextEra Energy, ticker NEE, which also makes up 5% of my portfolio. This is the prime definition of a core stock, as in it's showing some pretty good revenue growth and some really good dividend growth. They are what's known as a dividend aristocrat, which means that they've raised their dividends for 25 consecutive years. The other thing I like about this company is that it gives me exposure to traditional utilities, so think things like natural gas, as well as clean energy utilities. So NextEra is the largest renewable energy producer in the entire world, not just the US, and they have a very large exposure to wind energy, as well as some exposure to solar and nuclear energy. And I think that it's a great way to get exposure to the renewable energy thesis while still having the safety and security of a typical electric utility. Another part of my bull thesis for NextEra Energy is the fact that generative AI uses a lot of electricity, and companies like NextEra, which produce a lot of renewable energy, might see some increased demand because these large companies like Microsoft are looking to go green and use a bit more renewable energy as opposed to traditional fossil fuels. Next up is good old Starbucks. This is my 9th largest position at 4% of my portfolio. Now, in my last portfolio video, this was my top stock, and what happened was I ended up trimming because the stock rallied like 24% in one day on the news of a CEO change. So they were able to poach the CEO from Chipotle. Now, Chipotle's been having incredible execution. Starbucks, not so much. So this was a really, really good swap for Starbucks. Starbucks, for me, provides great recurring revenue because even in tough times, people still like their coffee. Caffeine is addictive. Sugar is addictive. You put those two together and you have a winning recipe. Starbucks, in my mind, is synonymous with coffee. They are a premium coffee brand, and I think they're probably the most well-known coffee brand. They're hoping to continue to open stores and return to growth, and while their balance sheet isn't great, I do have high hopes for their new CEO, and personally, I order a lot of Starbucks, so that's what I call supporting my investment. The stock is a bit rich now. When I first started buying it, it was in the $70 range, and now it's in the $100 range. So while I don't like Starbucks as much as I used to, I still believe in their long-term prospects, and I'm still happy to continue holding the stock. It also pays quite a nice dividend. Next up is PayPal at 4% of my portfolio. Now, PayPal was one of my extreme value plays. When they were trading in the high $50 range per share, I thought that there wasn't a better bargain on the market, and I began accumulating a lot of PayPal, and then as soon as it started recovering, I just kind of stopped. Now, PayPal is a play on digital wallets, on cryptocurrency, on buy now, pay later, and just general payment processing and e-commerce. I'm quite bullish on e-commerce. I think that going forward, my generation, which is the Gen Z and Millennial, I'm right on the border there, I think that generation is going to continue to buy things online, and I think PayPal is well positioned to benefit from that shift to e-commerce. Additionally, they have an extremely low valuation on a PE and price to sales basis, and they're still managing to grow revenues. What happened that initially sent PayPal down was the fact that they were seeing negative growth in their monthly active users. Now, this wasn't a big deal because their new strategy was, rather than going out and getting more active users, tons of people already use PayPal, so it's going to be quite difficult. Rather than getting more active users, they are trying to monetize their current active users even more. So transactions per active user are actually going up, which is leading to greater revenue growth. Next up is good old Lululemon at 4% of my portfolio. It's a very, very well-run athletic wear brand. They've been showing really strong revenue growth, and even with these economic headwinds we've been seeing, they've been continuing to grow revenues. Now, this growth is a lot lower than people expected it to be for this year, and that's why the stock went down, down, down. However, I saw that as an opportunity and bought, and now it's been recovering nicely. So I did actually trim Lululemon recently, but I'm still holding the rest of my position at 4% of my portfolio for the long run. I really believe in this company. Very strong margins. They are planning to expand internationally, and I think they'll do a really good job navigating these current economic conditions, but time will tell. Next up is Mondelez, ticker MDLZ, and this also makes up 4% of my portfolio. This isn't the most exciting company. Mondelez sells cookies, crackers, biscuits, and other snack foods. They also sell chocolate. They own Cadbury's. If you're from the UK or Australia or somewhere outside of the US, Cadbury's is quite a large brand. Personally, I believe that this company is sporting a really attractive valuation. They do a lot of business internationally, so when the new president-elect was announced in the United States and fears of tariffs began to rise, this stock went down, 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 and I think that this presents a really nice opportunity for investors who might want a little bit of consumer staples exposure. Now, for those unaware, consumer staples is things like grocery products. So food, drinks, alcohol, tobacco, toilet paper, that type of thing. Mondelez isn't just any boring old consumer staples stock. They are still showing some revenue growth, and I think they have a lot of innovative brands. For example, they own Oreo, and we all know that Oreo is always getting up to some weird things and making some weird new flavors, but people are buying them. Next up in my portfolio is Xylem at a 4% weight. This is my 13th holding in my core portfolio. Xylem is a water technology company, and if you know me, you know that I'm quite bullish on the water thesis. Essentially, I believe that clean, potable water is only going to become more and more scarce as time goes on, and it's no secret that water is vital to pretty much anything we do. It's more than just drinking. We need it for washing, bathing, showering, flushing the toilet, and businesses also need water too. Think manufacturing companies that need water to build things, pharmaceutical companies need water. Xylem just has a very, very large market. And what I like about Xylem is that even though they're an industrials, they're a hardware company, they have really nice margins because they've been supplementing this with technology offerings, with software solutions. They recently acquired a company called Evoqua, and now Xylem and Evoqua together make up the world's largest water technology company. And that's something that I think is quite exciting. It gives you exposure to utilities, right? Because water is a utility, while also giving that exciting technology feel. Next up is Nucor. Now, again, Nucor, nothing too exciting. It's 4% of my portfolio, and this is a steel company. Now, they're also the largest recycler of scrap metal in the United States, so they have a bit of that sustainability and green thing going on that I like. Nucor stock has been beaten down lately because when the economy is rough, demand for steel goes down because steel is used a lot in the automotive industry. So in my mind, this is a temporary setback for Nucor. Again, they're a dividend aristocrat, and it's nice that they have two different business models where they do produce steel, but they also recycle scrap metal. So even when the economy's tough, they can get that extra revenue from recycling scrap metal. It's a well-diversified steel play, and it makes up my materials exposure in my portfolio. Next up is Monolithic Power Systems, ticker MPWR. This is a newer ad for me, which is why it's a little bit lower on the list, but I am quite bullish on this company. Essentially, they make power semiconductors. Now, these are chips that pretty much any electronic device needs, and they're seeing some great growth due to AI. These chips are being included in NVIDIA's Blackwell architecture. Monolithic Power Systems chips are being used in data centers, they're being used in robotics applications, in automation applications, and in electric vehicles. So they have a lot of exciting tailwinds. However, some of those industries are experiencing downturns, like industrial automation and electric vehicles, both not really doing so well right now. However, they've been able to offset this with some insane growth in their AI division. Now, the stock was beaten down recently because of a report that found that they may be losing market share in NVIDIA's Blackwell architecture, but it's well known that NVIDIA likes to diversify their suppliers and not rely solely on one supplier like Monolithic, so it shouldn't come as a shock that they may lose a little bit of market share, and they also benefit from being a fabless semiconductor designer, which means they outsource the manufacturing of these semiconductors, and they just design it and get to collect those really, really nice, strong margins. Next up is Clean Harbors at 3% of my portfolio. I talked about Clean Harbors in my video where I said these are the two stocks I will never sell, and I believe it. Clean Harbors is an interesting company. They started out with just a few people and a truck, and now they're a much larger company. They're still small, but over $10 billion in market cap. Clean Harbors has found a really nice niche in pollution control. However, they also offer services like waste incineration and environmental cleanup after disasters and any kind of hazardous waste spill. This is an industry that has really high barriers to entry because there's a lot of government regulations around these industries. So Clean Harbors already being involved in these industries bodes very, very well for them. It's going to be hard for competition to come in and displace them. They've been showing some steady growth, and they have decent margins for, again, an industrials company. They're also the largest recycler of oil in the United States. So I think their diversified business model and strong execution, as well as these high barriers to entry in this industry, make Clean Harbors a really nice hold for me. Next up is Ulta, and Ulta only makes up 3% of my portfolio, but that's only because it's a bit on the smaller side. I'm still quite bullish on Ulta. Ulta is one of the two leading beauty and cosmetics retailers in the United States. The other is Sephora, which is owned by LVMH. Ulta is interesting because it's more than just a retail location. It's a bit of an experience. Ulta stores come equipped with a salon where women and men can go in and have a salon experience while also shopping for cosmetics and beauty products. They've been able to maintain some pretty good margins for a retail business, which tend to typically have lower margins. And they are a serial buyer-backer. They buy back a lot of their shares. Additionally, this company has been able to grow and expand without taking on too much debt, which I really, really like to see. I love a good balance sheet. Next up is Icon PLC, ticker ICLR, which makes up 3% of my portfolio. This is another picks and shovels play on the pharmaceutical industry. Essentially, this is a clinical research organization that partners with pharma companies to help them get their drugs to market. Now, again, just like Thermo Fisher, this stock saw a lot of selling pressure. However, I thought that this was overblown, and I actually ended up buying a lot of Icon near their 52-week lows before they started to recover. I still think Icon is at a great price, and I'm happy to continue holding this company. I'm interested in the pharmaceutical sector. I think that it's a sector with a lot of growth. However, investing in a single pharmaceutical company, to me, bears a lot of risk because drugs can go off patent. FDA trials can go poorly. Capital can run out. Interest rates. There's so much that goes on with a pharma company. Whereas if I invest in a company like an Icon or a Thermo Fisher that serves the pharmaceutical industry but isn't as exposed to those risks and is a bit broader and more diversified, I feel like I can get exposure without some of the risks, and I really like that. Next up is Pure Storage, ticker PSTG. This is a data storage company. More specifically, they sell flash arrays. Now, flash storage is a type of data storage that's supposed to be a bit more cost-effective for their end user. In fact, Pure Storage claims that their customers save money, which has led to some pretty strong historical revenue growth. They also have some amazing margins. For selling a hardware product at 70% gross margins, I'm pretty astounded by that. I do believe that competition and pressure will eat into those margins in the future, but it's nice that they're starting out on a really high mark. They also offer storage as a service, or SaaS, I suppose, which is a source of recurring revenue, which is really nice to see for a hardware company to have some recurring revenue. Gartner names Pure Storage a leader in enterprise data storage, and I don't believe that that leadership position is going to go away anytime soon. They do have competition from companies like Dell, HP, NetApp. However, I think Pure Storage has a really nice business model that some of those other companies don't have, where they offer strong margins on both the hardware and the services side. And I think that the growth in big data and AI is going to be a really great thing for Pure Storage, and I'm happy to continue holding them in my portfolio at a 3% weight. And last but certainly not least is Darling Ingredients at just 2% of my core portfolio. It is my 20th holding, and this is a very interesting company. They break down their business into 3 segments: feed, food, and fuel. I like the alliteration. Feed is essential ingredients for animal nutrition, fertilizers, and renewable fuels. Food is ingredients to enhance human wealth and well-being. The gelatin falls into this area. And fuel is powering the future with low-emission energy solutions. They have a joint venture with a company called Diamond Green Diesel, and this has helped them to establish a position as one of the largest producers in renewable diesel in the entire world. They're branching out into sustainable jet fuel, which I think is going to be an exciting growth driver for the company if they can pull that off. And they have a 15% market share in turning animal byproducts into new things like feed. I really like sustainability as an investment thesis, and I think as time goes on, companies and governments are going to throw more and more money into businesses that are sustainable and can help them reduce their footprint on the environment. And I love companies that take something that would normally go to waste and turn it into something that can be used. So Darling, it's a bit of a risky play. It's a smaller company, less than $10 billion in market cap, but I believe that their low valuation and some growth drivers in the future, such as that biofuel for jet planes, is going to make it a good long-term performer. Let's hope, at least. Anyway, thank you guys so much for sticking around and watching this whole long video. As always, this is not investment advice. I am not recommending any of these stocks. These are simply the stocks that I've chosen to invest my own money in. Let me know what you guys think of my portfolio down below, and if you're new, please subscribe to the channel. I post stock deep dives and stock analysis on a pretty regular basis, so if that's your thing, definitely follow me along for the ride, and please like the video if you liked it, and dislike the video if you disliked it, and tell me what you would have liked to see instead. Thank you guys so much, and have an amazing day.